You know it's bad when the CEO of JP Morgan Chase says the following, quote, "I was surprised to see how much leverage there was." Oh boy. 3 days ago, folks, the Bank of England warned us that you have, quote, 3 days left to basically get your affairs in order for potential massive pain in the markets and the potential collapse of the 6th largest economy in the world. That's the United Kingdom. It used to be the 5th largest. Well, today, that time is up. And in this video, I'm going to catch you up to speed with some new clarity on the near bankruptcies that happened over the last 3 weeks. I'll give you some insights into this. We'll also talk about what's happening today and, most importantly, what's next. Now, before we begin, it's important to remember the most important thing that happens next is the expiration of that coupon code link down below for all of the programs on building your wealth. Keep in mind that once this coupon expires, we're paring back some of the lifetime access benefits because we're coming out with a complete revamp of the wealth course specifically, and so some of the benefits there are going to be different. So if you want lifetime access, make sure you join before 11:59 tonight. You'll get lifetime access to any of the courses that you get, whether it's the lectures or access to the live streams for however long I do them, which I expect to be very long because I enjoy doing them, and they're a great way to share insights in the market with you. All right, folks, let's get into the Bank of England. On September 6th, Liz Truss took over as Prime Minister of the United Kingdom, replacing the disgraced Boris Johnson, whose reputation had really faltered during his handling of COVID and allegations that he was regularly partying as the country was in lockdown. This became known as Partygate. 2 days later, after Liz Truss took over, Queen Elizabeth died, and Queen Elizabeth was put to rest on September 19th, 11 days later. Then, just 4 days after that, not even 3 weeks into Liz Truss's new role, her Treasury Secretary, or the equivalent of that, the Chancellor of the Exchequer, Kwasi Kwarteng, announced plans for a mini-budget to be voted on in November. And in this budget, he called the United Kingdom a country of entrepreneurs and said that the way out of the depressive economy we face now is to simply reduce taxes for a lot of people, and specifically reduce taxes for rich people by, for example, cutting the top tax rate from 45% to 40%, and instead of raising the 19% corporate tax rate to 25%, getting rid of that hike, as well as cutting stamp duties to buy real estate and offering stimulus for energy bills to businesses and homeowners. All of this should have been made official in November. Of course, that night, Kwasi Kwarteng allegedly went out partying with hedge funds who likely stand to benefit from the now lower top-tier taxes. That was on a Friday. But on Monday, oh boy, the market let Liz Truss's staff know they hated this. Because to the market, it sounded like the United Kingdom was about to spend a whole lot more money and reduce tax revenues during an inflationary time, basically stimulating the economy while reducing revenue for the government, requiring essentially more money printing, which again is more inflation, all while interest rates should be going up to lower inflation, especially when the inflation rate in the United Kingdom is just down from a high all the way down to 9.9%. Yeah, that's right. They almost have a 10% inflation rate in the United Kingdom. So when you couple a 10% inflation rate with a bunch more stimulus, of course, the market's going to freak. And over the next week, the British pound collapsed to a new low of $1.03. That is, 1 British pound could buy you $1.03, almost at 1-to-1. It did recover to $1.12, but not before causing massive stress in the bond market and really exposing, as Warren Buffett says, when the tide goes out is when you really find out who's been swimming naked. See, what happened was basically their equivalent of the 30-year Treasury bond, known as gilts. It's just a bond. It's like an IOU in Great Britain. They lost 20% of their value extremely quickly. So just think about owning a stock, just as an example. Let's say it's worth 100, and now all of a sudden it's worth 80. Well, originally, if you're sort of a buy and holder kind of person, this isn't a big deal. You're just like, all right, well, I mean, that sucks. You know, I can buy more if I have some cash, or I just hodl and hope one day it recovers, right? But pension funds aren't buyers and holders. They're borrow, buy, and holders. In fact, there's an entire pension fund system that's known as LDI Asset Management, and it stands for Liability Driven Investment Management. This is why Jamie Dimon came out and said just today, I was surprised to see how much leverage there was in some of these pension plans. And that's exactly where the real drama came, in these LDIs. Basically, because interest rates have been so low for over a decade, in order for pension funds to do their job, they felt the need to borrow a lot more money. Remember what pension funds do. They're basically a retirement plan for you, right? Let's say you retire and you're promised a pension of £50,000 a year for the rest of your life. Just call it $50,000 a year for the rest of your life, right? You put 30 years in, you expect to get that pension or retirement, whatever. The pension fund needs to invest money that they have today to make sure they can make those payments to you every year in the future. Well, because interest rates were so low and cash flows were so low on the things that they could invest in, they decided the best thing to do is just borrow money to increase their returns. And, that works really well when the market's going up. But it becomes a problem really fast when all of a sudden, rapidly, bonds drop 20%. And this quickly led to a spiral of panic as pension funds were starting to get margin called on debt due to the rapidly plummeting value of their assets. This led pension funds to sell more bonds, depressing value further, and this spiraling is known as a doom loop. Right now, there's about $1.5 trillion Great British pounds worth of LDI investments in the system. So basically, it's a way of saying it's potentially a too big to fail segment of the entire UK economy. On top of that, one of the custody banks that was dealing with these pension funds had so many margin calls they were dealing with, they didn't even have enough staff to help process how many margin calls were coming in. And there wasn't enough liquidity to make this easy to cover. That means pension funds didn't have enough cash, so they had to dump to be able to move money and cover. So there are a lot of steps involved. The issue here wasn't so much that rates went up and bonds fell, it's just how quickly the bond market reacted when Liz Truss's crazy plan came out, which ultimately seemed like it would require more rate hikes to prevent even more inflation. So, after this insanity, the Bank of England intervened on September 28th, just 5 days later, promising an unlimited bailout, basically setting a floor price under the price of these bonds. This helped gilts regain somewhere around 20% in value, but they also quickly gave that up again because the United States inflation rate came in on October 13th at a completely disastrous level. And see, the more the Fed raises rates, the more people are attracted to invest in US bonds, and so they dump their UK bonds and go invest in something they think is safer, like US bonds. That's really bad for the United Kingdom and just creates more pressures for them. So, to ease the drama even further than the central bank saying we're just going to buy all the bonds we can and basically bail everyone out, which we'll get into some more detail about how much they actually were able to pull off, Liz Truss's government U-turned. They killed the idea of getting rid of the top tax rate on October 3rd. They will not eliminate the 45% tax bracket. And at this point, her popularity fell to a lower level than Boris Johnson's popularity or approval rating, which is kind of sad because she's only 3 weeks in her job. And today, she U-turned again. She said that the corporate tax rate will not actually be held at 19%. They're going to take that 25% rate hike back, and they're going to move corporate tax rates to 25%, that is, in April as planned. And after Kwasi Kwarteng ran out of the IMF in Washington yesterday, he came back home to learn that he had been fired. He now has the award, by the way, of the shortest serving Treasury Secretary in almost, Chancellor of the Exchange, in almost 190 years. He's right there in the yellow box there on the left. After having served just 38 days, he's the second person ever to have such a short term in the UK's history. Now, today, Liz Truss said that her plans went, quote, further and faster than markets were expecting, so she appointed someone else to the job of Kwasi Kwarteng. This new person is named Jeremy Hunt, and the goal is that maybe he can relax markets a little bit. Now, what's with this whole 3-day thing? So, on Tuesday, Andrew Bailey said, he's the head of the Bank of England, that's their central bank. He told pension funds and investment institutions that you have, quote, 3 days left to offload any bonds that you have. And he said, quote, you've got to get this done. And while the Bank of England said they would buy up to an unlimited amount of bonds, they set aside an expectation that they might have to buy around $100 billion of bonds. Well, today, day 3 has come, and take a look at what we have. This is the total number of bonds that have been bought, and as of today, only $19 billion in bonds have been bought. The majority of those were bought within the last 3 days. right before the deadline, which sends a little bit of a signal that potentially pension funds just aren't actually ready to be able to liquidate and take advantage of the Bank of England's deal, though there's also the argument that what the Bank of England was willing to pay was basically locking in losses. It's kind of like, hey, we'll bail you out of your, crappy $100 stock that's now worth 80, and we'll bail you out at 80. And you're like, but I don't really want to sell at 80. Like, I guess I'll give you some. Anyway, technically now, the Bank of England is done. And so now there are concerns that pension funds were not prepared enough to be able to sell. I mean, you heard about the debacle of how hard it was just during the margin call era. And so some folks are saying, this is now a bomb ready to explode. Now, that's the more dark side. Of course, you have positive people like Larry over at BlackRock. They do a lot of LDI investing, by the way, and he's the CEO. He's a little more optimistic. He thinks that this whole craziness we just went through is a way of normalizing the markets more. Of course, that's also what was said when Bear Stearns failed to join the bailouts of 1998, and then they famously blew up and went bankrupt during the Great Recession just 10 years later. The CEO of JP Morgan plays both sides here. He says on one hand, quote, "My experience in life has been that when you have things like what we're going through today, there are going to be other surprises. Someone is going to be offsides." In other words, warning of coming bankruptcies and surprises that we're not even aware of yet. Now, at the same time, he also says, hey, but it looks like at least some of the problems are being resolved now, and we don't see anything that looks systemic. That's his argument. My response is, yeah, you don't see that yet. So, what happens next? Well, the bailout floor is technically gone. And if panic strikes again, it's going to be a matter of the market to deal with it, unless, of course, the central bank intervenes again, which would totally create moral hazard and crush their credibility, because they said they're done. So if they come back, nobody's ever going to believe them again, and they're just going to think they're always going to come to save the day. Well, if markets have to deal with any kind of pension fund blow-up, then pension funds could end up going bankrupt. Now, people are still technically owed their money from the corporations they worked for, their pensions. So that means if pension funds go bankrupt, corporations have to pay those pensions. And if corporations have to pay those pensions, they could see their stock values plummet. Massive corporations could see their stock values plummet because now they have to absorb all of these extra costs. The only way out of this would be if the corporations end up going bankrupt, which they could do, which would absolutely decimate shareholders and potentially have global implications of companies just going bankrupt one after another, kind of like dominoes. But ultimately, you'd probably see the government slide in to try to restore some faith in the pension system and make sure that the 11 million pensioners in the United Kingdom are covered. Of course, in the meantime, you'd have some massive shockwaves spreading through the economy. Again, there's also the flip side that the central bank could jump in, but again, that kills credibility even more than credibility has already been killed. And so really as sort of like a longer bottom line to all of this, beyond the idea that you got to check out those programs on Building Your Wealth link down below and use that coupon code before it expires tonight. Rising rates is dangerous. Rising rates and seeing rates go up really fast is even more dangerous. This is when quantitative tightening starts to feel like quantitative destruction. And we haven't actually really had full quantitative tightening yet. It just shows you that, again, the people who are out there swimming naked or high in debt are getting exposed. And unfortunately, those could be really big institutions. So somehow, pension funds right now are trying to come up with up to £280 billion just to have enough collateral to stop the margin pressures. Now, this could end up leading to some short-term corporate borrowing, where the pension funds are basically like, hey, corporation, we need some time to dump some other assets. Can you just lend us a bridge loan and we'll pay you back as soon as we go sell some other stuff? Fine, that buys the pension fund some more time, but guess what they end up liquidating then? Well, they probably end up liquidating things that take longer to sell, like real estate. After all, in the United States, for comparison, 87% of pension funds that are public and 73% of private pension funds invest in real estate to a high degree. And selling now could give them the opportunity to lock in relatively higher prices and build capital buffers that they need to buoy debts that they've taken on somewhere else. Now, while that might help offload some of the risks of these pension funds, it's possible you could end up seeing a real estate property crash because of pension fund offloading in both the United Kingdom, the United States, and potentially even other countries. Consider the Netherlands. The Netherlands have the world's biggest pension system at 214% of their gross domestic product, with over $1.9 trillion in assets, almost all of it in defined pension plans, exactly the type of plan that frequently uses liability-driven investment, LDIs. So, what could happen? Well, you could have a few things happen. One, the United Kingdom could start a domino effect of margin calls, pension fund bankruptcies, and corporate bankruptcies, which end up flooding to liquidations in the real estate market, in the United States market, and the Netherlands market. This could cause a global depression. Or nothing could happen. And this was all just a little bit of a warning call. Don't take out too much debt. I don't know. What do you think?